If you are currently retired in Australia, or you are fast approaching your 67th birthday, I need you to listen very carefully to what I am about to tell you. Right now, there are significant changes rippling through the Centrelink system updates that took effect following the major March 2026 indexation cycle that the vast majority of retirees are going to completely miss. We aren't just talking about a minor cost of living adjustment. We are talking about massive shifts in the asset limits, historic income threshold expansions that could mean you qualify for an age pension for the very first time in your life, and a quiet structural normalization of deeming rates that could actually slash your fortnightly payments if you are completely unprepared. Most pensioners look at their bank accounts, see a tiny automated bump from Centrelink, and assume everything is business as usual. But behind the scenes, the technical math has completely shifted. If you don't understand these new boundaries, you are either leaving thousands of dollars of legal entitlements on the table, or you are blindly stepping into a catastrophic Centrelink debt trap that could take years to clear. So today I am Professor David Henscher, and we are going to completely unpack the brand new 2026 pension changes in exhaustive detail. We will cover the new maximum payment rates, the expanded asset thresholds, the new income cutoffs, the hidden deeming rate trap that took effect this March, the absolute reality of the principal home exemption rules, and exactly how to find out if you suddenly qualify for a part pension under these updated rules. By the end of this deep dive video, you will know precisely where you stand and how the 2026 framework impacts your retirement wallet. Now, if you want to make sure you never get caught off guard as these regulations evolve throughout the year, make sure to subscribe to the channel. Staying on top of these shifting baseline rules is your single best defense in retirement. Let us dive straight into the numbers. To truly understand what is happening in 2026, we have to look at the foundations of the system. When Centrelink assesses your eligibility for the age pension, they look at your life through two entirely separate lenses, the income test and the assets test. This is the baseline architecture of Social Security in Australia. Whichever test produces the lower pension payment is the one that Centrelink legally applies to your situation. If your assets test says you are entitled to a full pension, but your income test says you are only entitled to $50 a fortnight, then $50 a fortnight is exactly what you will receive. Let us start with the positive news, the actual physical cash landing in your bank account every second Thursday. Following the latest indexation, the maximum full age pension has officially increased to combat the persistent inflationary pressures facing Australian households. For a single person receiving the full age pension, the maximum rate has gone up by $22.20, bringing your total to $1,200.90 per fortnight. Over the course of a full calendar year, that adds up to roughly $31,223. For a pensioner couple combined, the maximum rate has increased by $33.40, meaning you now receive $1,810.40 per fortnight combined. Annually, that translates to approximately $47,070 of tax-free income. It is vital to understand that these specific figures do not just represent a base rate. These amounts include your core base pension rate, the full pension supplement, and the mandatory energy supplement. Every single component is indexed together to ensure your basic purchasing power does not erode completely. But here is the massive structural shift that most everyday people completely miss. Because the maximum pension payments went up, the outer boundary limits for the part pension expanded right along with them. The ceiling has been lifted. If you were previously told by financial planners or by Centrelink themselves that you earned too much money, or that you held too many assets to qualify for even a single dollar of the government pension, those old numbers are now entirely obsolete. As of the current 2026 rules, a single person can now have a fortnightly income of up to $2,619.80 before their pension drops to absolute zero. For a couple combined, that fortnightly income limit has stretched all the way out to $4,000.80. Think about what that means for a moment. Thousands of self-funded retirees who were completely locked out of the system last year are now legally eligible to claim a pot pension. And even if your part pension amounts to just $10 or $20 a fortnight, capturing that footprint inside the Centrelink system crucially secures you the pensioner concession card. This card is arguably worth more than the cash payment itself, as it unlocks massive discounts on life-saving prescription medications under the pharmaceutical benefits scheme, drastically reduces your council rates, slashes your water bills, and drops your electricity and automotive registration costs by hundreds of dollars every single year. But it absolutely isn't all good news, and this is the exact technical change that is catching thousands of self-funded and part pensioners completely off guard right now. While the government expanded the thresholds to account for inflation, they simultaneously ended the long-standing pandemic-era freeze on deeming rates, enacting an aggressive normalization policy that took effect alongside the March updates. Deeming is one of the most misunderstood aspects of the entire Australian welfare system, and it is the single biggest point of friction for retirees who hold investments. For those who don't know, deeming is the legal fiction system Centrelink uses to assume how much income your financial assets are earning. Financial assets include your cash savings accounts, term deposits, share portfolios, managed funds, gold bullion, and superannuation accumulation balances. Centrelink does not care what your investments actually make in the real world. If you have your money sitting in a zero-interest transaction account because you are terrified of the stock market, Centrelink does not care. They apply a standardized government-mandated interest rate to your total pool of financial wealth and use that calculated figure as your income. The Minister for Social Services adjusted these rates upward. The lower deeming rate has jumped from its historic low of 0.75% up to 1.25% for the first baseline bracket of your financial assets. Meanwhile, the upper deeming rate has climbed all the way to 3.25% for every dollar held over the threshold. Here is the exact trap this creates. Because Centrelink now legally assumes your investments are generating significantly more income than they did just a few months ago, your assessed income under the strict income test might artificially spike overnight. If you have substantial financial assets outside your family home, this technical adjustment can quietly reduce your fortnightly pension check, even if your actual bank balance and your actual dividend income hasn't changed by a single cent. It is an invisible penalty on your savings. To see exactly where you sit under the current 2026 asset testing framework, you need to carefully check the updated asset limits. Because the full pension thresholds shifted, the exact point where your pension begins to taper off and the exact point where it cuts off entirely has changed. Let us break down the current 2026 asset limits line by line so you can understand your specific category. If you are a single homeowner, your full pension asset limit is now $321,500. This means you can own your home entirely, plus have up to $321,500 in other assets like cars, furniture, and bank accounts, and still receive the maximum full pension. If your assets go over this amount, your pension starts to taper down until it cuts off completely at $722,000. If you are a homeowner couple combined, your full pension asset limit sits at $481,500. Your combined pension will scale down gradually across the spectrum until it hits the absolute cutoff point at $1,085,000. If you do not own the home you live in, the rules acknowledge that you face rental costs, so your limits are higher. For a single non-homeowner, your full pension asset limit is $579,500, and your pension cuts off completely at $980,000. And finally, for a non-homeowner couple combined, your full pension asset limit is $739,500, with the absolute maximum asset cutoff point stretching out to $1,343,000. You must memorize the golden rule of the assets test. For every $1,000 your assets exceed the full pension limit, your pension payment drops by exactly $3 every single fortnight. This is known as the taper rate, and it is incredibly aggressive. If you are a couple owning a home, and your assessable assets sit at $500,000, you are roughly $18,500 over the full pension limit. That means your pension is automatically reduced by about $55.50 a fortnight. If you buy a new car or your shares perform well and your assets rise unexpectedly, your pension drops further. If you do not report these changes on time, you are building an illegal overpayment debt. We are right at the midpoint of these critical updates, and if this is clearing up the immense confusion for you, please take a moment to subscribe and share this video with a friend or neighbor. These technical indexation details rarely make the evening news, yet they affect the daily household budget of millions of Australian seniors. Let us keep moving into the deep danger zones. Let us talk about land, because this is an area where rural and semi-rural Australians get completely destroyed by Centrelink rules without ever realizing they were in danger. Many pensioners live on large lifestyle blocks, hobby farms, or regional acreage that they have owned for 40 years. They assume that because they live in the house on that property, the entire block of land is completely exempt under the principal home rules. This is a massive, highly dangerous mistake. Centrelink applies a very strict private use test to land. Under standard legislation, only the house and up to 2 hectares of land on the same single title can be fully exempted from the assets test. A hectare is roughly 2.5 acres, so we are talking about 5 acres of land total. If your property is larger than 2 hectares, say you live on a 10-hectare bush block, that remaining 8 hectares of land must be valued by a government valuer, and that value is added directly into your assessable assets test pool. With regional land values skyrocketing across Australia over the last few years, an extra 5 or 10 hectares of land can easily be valued at $300,000 or $400,000 by the State Revenue Office. Suddenly, without moving an inch, without selling a single thing, and without having any actual cash in the bank, you are pushed way over the asset test limit, and your pension is completely cancelled. There are complex rules where you can exempt more than 2 hectares if you can prove you have a long-standing connection to the land of over 20 years and that the land is completely non-commercial. But navigating that paperwork with Centrelink is a bureaucratic nightmare that requires professional guidance. Now let us pivot to another massive structural trend that is catching families out across the country, the granny flat agreement. With the current housing affordability crisis in Australia, thousands of pensioners are selling their large suburban homes and entering into arrangements with their adult children. Perhaps you have given your child $500,000 from the sale of your home to pay off their mortgage, on the condition that they build a self-contained flat in their backyard or let you live in their spare room for the rest of your life. Centrelink has incredibly strict rules regarding what they call the creation of a granny flat interest. They do not care if this was a verbal agreement made over a family dinner. They will look at the exact amount of money or asset value you transferred to your children and compare it against their internal actuarial life expectancy tables and local accommodation cost algorithms. If you are 80 years old and you transfer $600,000 to your son in exchange for a backyard flat, Centrelink may determine that a reasonable value for a lifetime of accommodation in that area is only $200,000. The remaining $400,000 is immediately flagged as a deprived asset under their strict gifting and deprivation rules. That means Centrelink treats that $400,000 as if you still own it, keeping it inside your assets test for a rolling 5-year period and applying deeming rates to it under the income test. Your pension is wiped out, your money is completely tied up in your child's property, and you have no liquid cash left to live on. It is a catastrophic financial trap that tears families apart. Let us also look closely at retirement villages and land lease lifestyle communities, because the contract you sign dictates how Centrelink treats your wallet. If you move into a classic retirement village, you usually pay an ingoing contribution via a leasehold or license arrangement. If that ingoing contribution is higher than the difference between the homeowner and non-homeowner asset thresholds, Centrelink legally classifies you as a homeowner. This means your entry payment is treated as the value of your home and is exempt from the asset test, but you are locked into the lower homeowner asset limits. Conversely, if you move into a modern land lease community or a manufactured home park where you structurally purchase the physical cabin or modular home, but you pay weekly site fees to lease the land beneath it, your classification changes completely. In many of these setups, Centrelink classifies you as a non-homeowner. This gives you a much higher asset threshold to protect your remaining investments, and because you pay site fees for the ground, you can actually claim Centrelink rent assistance on top of your standard age pension payment. Getting this exact contract classification wrong when you report your new living arrangements can cost you hundreds of dollars every single month. Now let us address the absolute minefield of downsizing, because this is where good intentions meet cold hard regulatory reality. You have lived in your family home for 30 years. The maintenance is becoming too difficult. The gardens are overgrown, and you decide to sell the large family home for $1.2 million. You buy a beautiful small apartment down the road for $700,000, pocketing a clear $500,000 in cash difference. This is a sensible life transition. But what happens to that $500,000 while you are waiting to finalize the purchase or settle on the new property? Under the current 2026 rules, Centrelink structurally exempts the proceeds of your home sale that are earmarked for a new home from the assets test for up to 24 months. This gives you a 2-year breathing space to build or complete the purchase of your next primary residence without losing your pension due to the asset test. But here is the sting that catches almost everyone. While that money is completely exempt from the assets test during that transition window, it is not exempt from the income test. The moment that $500,000 hits your bank account upon settlement, it is hit by the newly increased 2026 deeming rates of 1.25% and 3.25%. Centrelink will deem that cash to be earning an income, and that assumed income can instantly drag your fortnightly pension check down to zero during the months you are waiting to buy your new home. Furthermore, if you take a portion of that cash difference and decide to execute a Downsizer contribution into your superannuation fund, you must be incredibly careful. While the rules allow anyone over 55 to put up to $300,000 per person into super from a home sale without counting towards standard contribution caps, once you are past your 67th birthday and receiving the age pension, your superannuation accumulation balance is fully accessible by Centrelink. Putting money into super does not hide it from their computers. What happens if you have to leave your home temporarily due to illness or permanently due to transitioning into a residential aged care facility? This is an area of profound emotional stress and immense confusion for families. If you are a single pensioner, and you leave your principal home to enter an aged care home, your vacant property remains completely exempt from the Centrelink assets test for a strict maximum period of 2 years from the date you enter care. During those 24 months, the value of your home cannot touch your pension. But the moment that 2-year clock runs out, the exemption vanishes entirely. Your former home is suddenly reclassified as an unexempt, accessible asset. If your family home in Sydney, Melbourne, Brisbane, or any regional centre is valued at $800,000 or $1 million, adding that amount to your asset test will completely obliterate your pension entitlement instantly. There is a major exception to this rule. If your legal spouse, partner, or a dependent child continues to live in that family home while you are in aged care, the principal home exemption continues indefinitely for as long as they reside there. But if you are single and the home sits empty, you have a rigid 2-year fuse before your pension is cancelled. If you decide to rent out the family home during those 2 years to help pay your aged care daily accommodation fees, you must remember that the rental income generated is fully accessible under the income test and must be reported immediately. Renting out a room in your house while you are still living in it has also become incredibly popular as pensioners struggle to cope with rising grocery and energy bills. While this provides great companionship and extra cash, you must navigate the Centrelink threshold safely. The physical structure of your home remains completely exempt because it is still your primary residence, but the gross rental income you receive from a boarder or lodger is generally assessed under the income test. There are specific calculations where Centrelink allows a deduction for the cost of providing meals or utilities to the boarder, but you cannot simply hide this extra cash flow. Failure to report rental income within the mandatory 14-day window is considered welfare fraud and will trigger an automated debt recovery process. This brings us to the strict, uncompromising rules around gifting and asset deprivation. Many loving parents want to see their children or grandchildren benefit from their wealth while they are still alive, perhaps helping them secure a deposit for a first home or buying them a safe car. Centrelink places an iron ring around your assets to prevent you from deliberately giving away your wealth to qualify for a higher taxpayer-funded pension. The gifting limits are absolute and have not been increased for years. You are legally allowed to give away a maximum of $10,000 in a single financial year and no more than $30,000 over a rolling 5-year period. If you decide to gift your granddaughter $50,000 to help her finish university and get a start in life, $40,000 of that gift is classified as an excess deprived asset. Centrelink will keep that $40,000 on their books as an invisible asset belonging to you for exactly 5 years from the date of the gift. They will apply asset testing and deeming rates to that missing money, dropping your pension payment accordingly, even though you no longer have a single cent of that cash in your possession. The overarching takeaway from the 2026 pension framework is that the system is completely automated, highly interconnected, and deeply unforgiving of compliance delays. Centrelink actively matches data with the Australian Taxation Office, state land title registries, major banks, and share registries. When you sell a house, register a car, open a new term deposit, or receive a share dividend, a digital flag is raised inside the Social Security network. The most common mistake pensioners make is assuming that Centrelink will eventually figure it out themselves, or that minor changes do not matter. The law states that you must notify Centrelink within exactly 14 days of any change in your financial or personal circumstances that might alter your pension payment rate. If you delay, if you report a share portfolio increase 6 months late, Centrelink will not simply adjust your payments moving forward. They will backdate the assessment to the exact date the change occurred. Calculate every single dollar of overpayment you received during those months, and issue an official debt recovery notice. Tens of thousands of regular, honest Australian seniors are hit with debt notices for $10,000, $20,000, or $40,000 every year, causing immense psychological trauma and financial distress. So what is your exact action plan right now to protect your livelihood under these new 2026 rules? First, you need to conduct a thorough personal audit of your current situation against all the parameters we have covered today. If you live on a large regional block of land, look up your council rates notice, check the land titles, and verify if you are creeping over that strict 2-hectare limit. If you have an informal family arrangement resembling a granny flat or shared equity with an adult child, you need to verify if that arrangement was formally declared and assessed correctly using the official life expectancy formulas. If you are actively planning to downsize your home later this year, you must consult a specialized financial advisor who understands the intersection of the asset exemption and the income test deeming rates before you sign a contract of sale. If you have given any money or assets away to family members recently, check your calendar and bank statements to make sure you are firmly within the $10,000 annual and $30,000 5-year limits. If you discover a discrepancy or realize you forgot to report an asset change over the last year, it is always safer to approach Centrelink proactively through your MyGov portal to correct the record rather than waiting for an automated data matching audit to catch you out. Second, do not try to fight this complex bureaucratic system all by yourself. There are fantastic, completely free resources available to Australian retirees. You can access free financial counselling services through the National Debt Helpline or seek advice from specialised advocacy groups like the Financial Information Service offices provided directly by Services Australia. These officers can run full scenarios on their computers to show you exactly how a house sale, a gift, or an investment change will alter your fortnightly pension check before you make an irreversible financial move. Third, and most importantly, you must commit to staying informed. The Social Security rules in Australia are not static. They are dynamic, highly political, and change constantly through indexation cycles every March and September, alongside federal budget policy shifts. The retirees who are best protected are the ones who know the rules of the game before they step onto the field. Before I leave you today, I want to say something directly to your heart. You earned this pension. You worked for decades. You paid your taxes. You built the infrastructure of this country. You raised your families. And you contributed to the fabric of our society. The age pension is not a charitable handout. It is a hard-earned entitlement that you are legally and morally owed. You deserve to receive every single dollar you are entitled to under the law, and you deserve to keep it without fear, anxiety, or unexpected letters arriving in your mailbox. But the system is built on a mountain of complex regulations designed by bureaucrats, and it is not made easy for the everyday person to understand. That is exactly why this analytical work matters so much. If this comprehensive breakdown helped you navigate the confusing 2026 landscape today, please give the video a thumbs up, drop your specific questions or experiences with Centrelink in the comments below, and share this audio script with your friends, your family, or anyone you know who is currently on the pension or fast approaching retirement age. Please subscribe to the channel and turn on all notifications so you never miss a critical policy update. I am Professor David Henscher. Your pension is your security. It is worth protecting with absolute knowledge, and I am here to help you do exactly that. Thank you for listening. Take care of your finances, and I will see you in the very next update.